Hey traders, Raghee here, and in this video we're going to go over gold and a few things to keep in mind, a few things that we've talked about. Much of trading is being able to sit through no man's land. That's the first thing. Now what does that mean? If you're a bit of a Momo addict, in other words, if once the market's going in your favor and you get in, but then it stalls or maybe moves against you before hitting the profit target and not quite reaching the stop, sometimes you're sitting through this very boring, frustrating place called no man's land. We're still in the trade. We've not been stopped out, yet we've not been able to hit a target. So we start looking for reasons to justify the position. That's not what we want to do. We know our position is valid as long as it's trading above the stop loss. For my gold trade, I've been using 1895 as a stop because even though we put this low in back here on the 12th, you can see that was at 1874.2 low. I'll make that a second trade. So if I get stopped out at 1895 and then 20 points south of that, I get an oversold gold opportunity, great, I'll do that. But for this trade, the validity is let's stay above the 1900 major cycle level. And I'll put my stop just below that. It could be 1897. I mean, there's no magical level by which to back off, but I know pretty much where my line in the sand is. So that's going to help me sit through no man's land because I know where the validity of my trade is. The other thing that helps a lot are narrow-bodied candles, and we had quite a few of them. I know it's a little difficult to see, but narrow-bodied candles like this one here, like this one here, they help me because the market's not really expressing a dramatic opinion to the downside nor to the upside. It's just in a holding pattern, which is fine with me because I don't want it to break down and I'm just waiting for it to break to the upside. Now, why do I feel so confident about that? That's sort of the final piece of the puzzle here. All right, so let's think about how we got to where we are right now, which, certainly is choppy. This area here where we're just moving kind of sideways. But how do we get here? I mean, there's no doubt that how we got here was an uptrend. So respect the trend that was. That's pretty much right out of Dow theory. Respect the trend that was. I'm going to favor the long side. I'm going to favor a buy because that's the psychology that got me here. I'm not going to assume a reversal. I never do on daily time frames. Intraday, different story. Daily time frame, not so much. The other thing that I'm going to view as really, for me, supporting literally and figuratively my trade and my theory about the long is the fact that we have seen since late June support at the +2 standard deviation of the V-score. So I have yet another reason to be bullish above 1900. Even that move here, as dramatic as this move was, it didn't make the V-score break the +2, which tells me that that move, while from a dollar perspective, a point perspective, was a big move, the volume wasn't enough to penetrate a +2 standard deviation. That tells me a lot, and that tells me that was a hugely participated move to the downside. So while it was volatile, it did not invalidate, for me, the bullish psychology of this market. So let's see how high is high. Now, this is the tough part. Okay, we're up. So what? Technically, we're still in no man's land. So what am I looking at? Target-wise, look, if we want to step out in front of 1950, the major psychological level, that's fine. Using the value area high right around 1987, 1985, that would be fine. I really am anticipating once real yields start moving again, I'm looking at this market testing the waters around 2050 again. Okay, we're in the December contract. I'm in no crunch for time. So as long as we stay above 1900, let's see how high is high. I'll see you in the next update.